What's up, everybody? This is Sunko, the Korean Bro. Today is 2024, June 7th. And let's read articles, okay? Hmm. I expect to have really interesting articles tonight because it's been quite a while. So, supposedly, there should be a lot of articles stacked up, right? Okay. Malifu.com. Hmm. Nvidia's 10 for 1 split isn't reason to buy the stock. By these three reasons are. Okay, let's see what these three reasons are. Nvidia hit a $3 trillion valuation ahead of its stock split on Friday. But those aren't reasons to buy or hold the stock. Long-term investors should keep their eyes and ears out for these three key factors. So, what are three key factors? Investors may be enthusiastic about stock splits, but business fundamentals are the only reason to purchase a stock. On Monday, the stock price of Nvidia will fall about 90%. But don't worry, Nvidia holders, you will also have 10 times as many shares as the company will perform the 10 for 1 stock split announced on its May 22nd earnings call. Stock splits don't change the underlying valuation of a company, but something there are reasons to buy your stock. Why? Because a lower share price could attract more retail investors who might not have the $1,200 required to buy a share of Nvidia today. But with most brokers now offering fractional share buying, splits may not pack the punch that they used to inspiring retail investor buying. One should never buy a stock based on what they think others may do in terms of buying or selling in the near term. Rather, one should focus on long term fundamentals. And for NVIDIA, those will be guided by these three all important factors. Okay, let's see. How wide the moat is CUDA. NVIDIA finds itself in such a strong position today because it has been so forward thinking. Um, the company began developing its CUDA software stack all the way back in 2006. CUDA allows developers to program graphics processing units to do parallel data processing, which is the reason developers have the ability to train artificial intelligence models in the tens of billions or even hundreds of billions of parameters today. Developers have grown accustomed not just to NVIDIA's chips, but also CUDA and are likely reluctant to learn a whole new platform to program other accelerators. That's especially true as companies currently are racing to train models and deploy them as quickly as possible. Okay, developers have grown accustomed not just to NVIDIA's chips but also CUDA and are likely reluctant to learn a whole new platform to program other accelerators. That's especially true as companies currently are racing to train models and deploy them as quickly as possible. NVIDIA has what's known as a network effect with CUDA. The more it has become a standard for developers, the harder it is for competitors to break in. However, investors will have to keep an eye out for competitive offerings. Companies are paying a fortune for NVIDIA GPUs and would definitely like a compelling alternative. Advanced Micro Devices is innovating its open source RCM software platform, which it claims can port CUDA code over to program AMD's MI300 line of GPUs. Intel is perhaps making the biggest push, bringing in other technology giants into something called the UXL Foundation. Unparalleled pace of innovation. Okay. Nvidia, perhaps sensing that its software may be under fire, made a big announcement last autumn that the company would be doubling its pace of innovation. Going forward, Nvidia will proceed from introducing a new chip architecture once every 2 years to once every year. On that note, the company recently introduced its new chip architecture for next year, codenamed Blackwell. Blackwell will boast 2.5 times to 5 times the performance of the prior Hopper architecture, depending on the use case. When packaging Blackwell into a new 72 superchip cluster with NVIDIA's updated networking technology, the cluster can achieve a stunning 30 times better performance over a similarly sized Hopper cluster. Blackwell was just announced back in March, but at the recent Computex 2024 conference in Taiwan, NVIDIA CEO Jensen Huang decided to announce the next architecture after Blackwell, codenamed Rubin. The company didn't disclose any performance specs around Rubin, but what can be sure is it will offer an even greater leap in performance over Blackwell. Now, NVIDIA is raking in the cash, giving it a massive amount of resources to invest in future innovation over AMD, Intel, cloud giants, in-house accelerators, and other venture-backed competitors. But like in software, competitors aren't standing still. Also, Computing's AMD announced it will now be moving to an annual architecture cadence. Intel is investing heavily in progressing through 5 new nodes in 4 years as it seeks to exceed NVIDIA fab partner Taiwan Semiconductor Manufacturing in terms of transistor leadership. If Intel achieves its roadmap and surpasses TSMC in terms of raw manufacturing capability, that will be an interesting competitive volley. Both competitors are definitely in catch-up mode, and both have a minuscule share of the AI chip market today. But these efforts are something to watch out for. And even as Nvidia pulls ahead with Blackwell and Rubin, how big is the AI chip market? Okay. Finally, another reason to buy Nvidia is the size of the future AI chip market itself. Hmm. Of course, the ultimate size of the market is currently the subject of debate. Some tech specialists believe the current AI market is overhyped and may peter out as today's boom turns up disappointing results. Look no further than an article in last weekend's Wall Street Journal in which a highly opinionated article proclaimed the AI revolution was losing steam in terms of end user benefits. Others disagree. Interestingly, some of the biggest beneficiaries of AI today aren't consumers but tech enterprises themselves, using AI to write code that would take lots of man hours or even help in designing semiconductors themselves. According to Deloitte, the 2027 AI chip market could fall anywhere between a conservative $110 billion to the more aggressive $400 billion recently put forward by AMD CEO Lisa Su. NVIDIA just recorded $22.6 billion in data center revenue in the past quarter. Of that, $19.4 billion was made up of computing chips, with the other $3.2 billion in networking revenue. So last quarter's results put NVIDIA on an $80 billion run rate already. If the chip market growth slows to reach just $110 billion by 2027, it will be very bad for NVIDIA given its current valuation. However, a $400 billion chip market would be more likely, and the more likely outcome. TSMC recently predicted on its last earnings call that the AI chip market will grow at 50% annualized growth rate through 2027. Conservatively, assuming an $80 billion market this year, that would translate into uh, a $170 billion market in 2027. Uh, Needless to say, the ultimate size of the end market is important for any stock that trades at a 71 price earnings ratio, as Nvidia did after Thursday's close. Investors should keep an eye out for a new AI chip forecast as well as end customer use cases, as these are further refined by leading industry participants. So pay no attention to a stock split. So while a stock split may get major headlines, more important than Nvidia's story is the strength of its softer moats, its pace of innovation, vis-a-vis its peers, and the total market size for AI chips, which will be predicated on the usefulness of AI. Those are the factors investors should concentrate on beyond next week. So what else do we have? Three reasons to buy Solana's. Well, it's under $200. Solana is trading nearly 40% below its all-time high. It's overcome most of its growing pains over the past 4 years. It could be a top token to own as the crypto winter finally ends. So it's a cryptocurrency stock. Uh, Comcast, Kraft Heinz, and Series XM are in the index and trade at discounted prices. They all have solid brands that have been struggling to generate growth in recent quarters. Comcast. Shares of telecom and media company Comcast are down around 10% this year. While its business is doing well, the company isn't exactly blowing the doors off with revenue growth. During the first 3 months of the year, revenue totaled $1.1 billion and rose by just 1.2% year over year. While its Peacock streaming service showed strong year over year growth at 55%, its number of paid subscribers comes to just 34 million, nowhere near the 270 million subscribers of streaming giant Netflix. With growth investors focused on artificial intelligence stock, Comcast numbers may not be all that attention grabbing, but there is promise of more growth ahead. Universal, which is part of Comcast, is planning to open the Universal Epic Universe theme park next year. It's going to leverage many iconic brands, including Donkey Kong and Harry Potter, which could lure some travelers away from Walt Disney theme parks and give Comcast a potential growth catalyst. Today, you can buy shares of Comcast for just 9 times its estimated future profits, which may prove to be a still of deal in the long run. What may sweeten the deal even further is its above average dividend, which yields 3.1%. Kraft Heinz also hasn't been much of a growth stock over the years. It has some top food brands in its portfolio, but it's rumored to be looking at selling one of them. Oscar Mayer, well, it's a potential transaction could fetch as much as $5 billion. Remove a top brand for Kraft, reduce the earnings power of the overall company. What may be concerning about Kraft is that there may not be a growth catalyst on the horizon to turn the stock's fortunes around. So in the first 3 months of the year, the company's net sales totaled $6.4 billion and were flat from the same quarter last year. While Kraft has some iconic brands, cash-strapped consumers could trade down to no-name products to save money if economic conditions deteriorate this year. For the past 4 years, Kraft's annual sales have been stuck within a range of $26 billion and $27 billion. Kraft stock does appear cheap, trading in less than 12 times its forward earnings. However, unless you want to buy for its 4.6% yielding dividend, this may be a stock to pass on despite its similarly low valuation. Year to date, the stock is down 6%. The worst performing stock on this list by far is a Series XM, which has lost half of its value this year. The broadcasting company is another business that has been struggling to generate revenue growth in recent years. Okay. Next NVIDIA. Will Microsoft do a stock split? So let's see what Cathie Wood buys. Wood added to her positions in Reddit, Intellia Therapeutics, and PagerDuty on Wednesday. Wood's out investor was the buyer of Reddit the day it went public in March. It has added to that position twice this week. Intellia Therapeutics and PagerDuty are trading lower this year, but both stocks moved higher recently on bullish news. Reddit, Intellia Therapeutics, and PagerDuty were among the 4 stocks that Wood bought on Wednesday. She added to established positions in all 3 cases. Let's take a closer look. Okay, Reddit. It didn't take long for Wood to own a piece of Reddit. She bought shares of the online community Bull the day it went public 3 months ago. She added to the Emoji stake 2 months later, the day after it posted blowout quarterly results in its first financial update as a public company. This week is the third time that our investor is putting more money to work on Reddit, even if it remains one of Wood's smallest overall holdings. Unlike many times when Wood is building up her positions, when they're on sale, shares of Reddit moved higher on Wednesday, as well as the day following its well-received quarterly report in early May. So Reddit went public at $34 in March. It's trading 77% higher today. Reddit's platform, a community of online communities, is sticky and popular. It reaches 82.7 million daily active unique users, a 37% increase over the past year. It's not as successfully monetized as large social media stocks, but it is taking steps in that direction. Revenue growth of 48% in the first quarter is better than the increase in its audience, so revenue per daily active user is on the rise. So So losses have been a problem at Reddit, but it did squeeze out immediately positive free cash flow, adjusted earnings before interest, taxes, depreciation, and amortization. Last month's quarterly report. And let's see Reddit posting reported profitability by 2026 and generating positive adjusted net incomes for the first time this year. The upside is there for a truly global platform. Mm. So nearly half of its daily actives are international, but average revenue per stateside user is still more than 4 times higher, or should now have momentum that comes with better brand awareness of a publicly traded consumer-facing business. Revenue has accelerated for 3 consecutive quarters, and that was before the IPO. So this has been a rough year for Wood's performance numbers. Many of her top holdings are trading lower this year. However, her decision to buy Reddit early and add to it in subsequent months is paying off so far. So what is Intellia Therapeutics? What isn't just adding toward winners. Intellia Therapeutics is down 24% in 2024. Uh, and trading 44% lower over the past year. However, the gene editing stock is moving higher this week. Intelli investors got a boost this week after positive test data. Intel is working on CRISPR based therapeutics, including a pair of promising treatments entering the third phase of clinical trials. This week's upbeat news comes from an NTLA 2002, a potential single dose treatment for hereditary angioedema that is much earlier in the clinical trial process. Okay. Okay, what else? Broadcom. Okay. See, okay, the second supercharged growth stock billionaire asset managers couldn't get enough of during the first quarter. Semiconductor kingpin Broadcom, with 41% sales growth expected in the current fiscal year. 6 billionaire investors piled in, including. Mm, okay. Okay, the fuel lighting a fire under Broadcom stocks, artificial intelligence revolution. While it may not be as direct of a beneficiary as graphics processing unit developer NVIDIA, Broadcom has found its niche in AI accelerated data centers. Last year, Broadcom unveiled its Jericho AI chip, which can connect up to 32,000 high compute GPUs. Processing expediency is paramount to training large language models. Mm. Overseeing generative AI solutions and making the split-second decisions required of AI-powered software and systems. Jericho 3 handles this while minimizing tail latency. Broadcom is also a dominant player in the smartphone arena. So it provides wireless chips and accessories used in next-generation smartphones. Wireless companies upgrading their networks to handle 5G speeds have encouraged a consistent device upgrade cycle that's powering Broadcom's cash flow higher. These half dozen billionaire money managers might also be anticipating a possible stock split in Broadcom's future. Shares of the company did close at nearly $1,331 on June 4, which can be a lot of money for retail investors who don't have access to fractional share purchases with their online broker. The stock split stocks have outperformed in recent years, with investors gravitating to these typically high flying businesses. Hmm. So the hyper growth stock billionaires give the have ho meta platforms. Billionaire Bill has 66% of his portfolio invested in three Brazilian stocks. So what are they? Waste Management is the largest waste collection and disposal company in North America, and the essential nature of its business makes it somewhat resilient to economic turbulence. Berkshire Hathaway ranks among the largest property and casualty insurance companies, and Warren Buffett has invested the capital from insurance premiums to a great effect. Microsoft has a strong presence in the enterprise software and cloud computing markets, and the company is leaning into artificial intelligence in both areas of its business. Hmm. 34% of the portfolio, 16% of the portfolio, 16% of the portfolio. Okay. The Bill and Melinda Gates Foundation Trust generated 47% return during 3 year period that ended in March, while the S&P 500 returned the last impressive 32%. As of the first quarter, the BMG Foundation Trust has 66% of the asset invested in just three stocks. Mm. These companies have been brilliant long-term investments. All these stocks outperformed the S&P 500 over the last 3 years, and two have been particularly resilient during the bear markets. Are they still worth buying? Mm. Okay. Waste Management, 16% of the BMG Foundation Trust. Waste Management reported mixed results in the first quarter. Revenue increased 5.5% to $5.2 billion, lagging the 6.7% growth Wall Street expected. But GAAP net income still jumped 35% to $1.75 per diluted share, easily beating the 15% growth analysts anticipated. The bull case for Waste Management centers on its position as the largest waste collection and disposal services provider in North America as measured by revenue. The company also controls 28% of the US landfill volume, while its closest competitor controls 20%. Brian Bernard and Morningstar says that advantage is nearly impossible to replicate given immense regulatory hurdles. More broadly, waste management provides essential services, meaning demand should remain roughly constant through economic ups and downs. Additionally, its vast network of transfer stations and landfills creates an economic moat that fuels the company pricing power. Brian Bell recently wrote, landfill scarcity has supported pricing power for waste management, with annual core price increases consistently exceeding inflation. Those qualities make waste management a resilient business, and like Berkshire Hathaway stock has consistently outperformed the S&P 500 during bear markets. Mm. Going forward, the waste management market is projected to grow at 5.4% annually through 2030. Wall Street expect waste management to grow earnings per share at 11.1% annually over the next 3 to 5 years. The estimate makes the current valuation of 33 times earnings seem a bit pricey. Those numbers give a PG ratio around 3, but I would feel more comfortable buying shares if the multiple was closer to 2. Okay. It's tough reading line by line. Um, anyway, this is it for today, and see y'all and have a great night. Okay, bye bye.